CPI dropped yesterday. Gold rallied to $4,424. Silver closed at $66.20, up more than 3% in a single session. And if you spent yesterday watching the headlines, you might think the big data week is done, that the number everyone was waiting for landed, the market reacted, and now it's just a matter of watching gold hold its gains. It isn't done. This morning at 8:30 a.m. Eastern, right now, as many of you are watching this, two more reports are dropping simultaneously: the Producer Price Index for July and initial jobless claims. Most people who own gold or silver tonight have no idea these two reports are coming, and most of the people who do know don't fully understand what they measure, how they connect to the Federal Reserve's rate decision in September, or why, in this specific week, with this specific combination of data already in the mix, they carry more weight than a normal Thursday morning. That is what this video is, a complete pre-market breakdown. Before 8:30 this morning, you will know exactly what each of these reports measures, what the scenarios look like for gold and silver, and the words sitting quietly underneath all of it that the mainstream coverage still isn't saying clearly. Let's get into it. Before we go further, quick ask. If you want research-backed breakdowns of what's actually moving gold and silver before the headlines tell you what to think, hit subscribe and turn on notifications. I put the work into these before the data drops, not after. And drop a comment below right now. Which scenario do you think today's PPI prints? Hot, cool, or in line? And what's your gut telling you it does to gold? I read every comment. The best answers get pinned. Now let's map this out. Section 1. What happened yesterday? The full picture. Let's start with where we actually are, because understanding yesterday completely is the foundation for understanding today. Yesterday morning at 8:30 a.m., the Bureau of Labor Statistics released the Consumer Price Index for July 2026. Headline CPI came in at 3.4% year over year. Prices rose 0.1% on the month. Core CPI, the reading that strips out food and energy, came in at 2.5% annually and 0.2% for the month. Every one of those numbers matched exactly what economists expected. No upside shock, no major downside surprise. In market language, in line. Gold and silver moved immediately and sharply higher. Gold climbed to approximately $4,424 per ounce, a 10-week high. Silver surged past $66, up between 2.5 and 3% on the session. Gold is now trading at levels it hasn't seen since early June. Silver broke above a downward trend line that had been defining its price action for weeks, a technically meaningful event I'll come back to in detail. Why did metals rally on an inline CPI print? Here's the key. The market was bracing for a possible hot number. Oil has been elevated, Brent crude trading near $83 to $86, because the Strait of Hormuz situation has kept energy costs pressured. Every time there's a new development around Iran and that waterway, oil moves. And when oil moves, inflation expectations move with it. The market had priced in meaningful risk of an upside CPI surprise. When that surprise didn't arrive, the relief trade fired. But here's the crucial number that did not change yesterday: the probability of a Federal Reserve rate hike at the September meeting. It stayed right around 48 to 52%, a coin flip. Yesterday's CPI was not soft enough to take September off the table. It was just soft enough to keep it uncertain. And that uncertainty is exactly what this morning's data hits directly. Here's the thing most people missed in all of yesterday's green numbers. Yesterday's CPI only answered half the question. It told us what prices look like at the checkout. Today's PPI tells us what's still sitting in the pipeline, at the factory level, at the farm gate, at the warehouse, before it ever reaches a consumer. And those two readings don't always agree. When they don't, that's when things get interesting. Stay right here. Section 2. What PPI actually measures and why it matters today. PPI stands for Producer Price Index, and the difference between PPI and CPI is not a technicality. It is the difference between seeing a fire and seeing the smoke before it arrives. If CPI measures what you pay at the checkout, the price of the finished loaf of bread in your hands, PPI measures what happened upstream. It tracks the price the bakery paid for wheat, the price the wheat farmer paid for fertilizer and fuel, the price the distributor charged to move the bread from the factory to the shelf. Every cost that goes into making a product before it ever reaches a consumer. That is PPI. Here's why that matters for the Federal Reserve and for gold. PPI is tomorrow's CPI. When production costs rise sharply, those increases don't stay at the factory, they travel downstream. The bakery that paid more for wheat charges more for bread. the distributor that paid more for fuel charges more for delivery. Eventually, sometimes weeks later, sometimes months, those costs show up in what you pay at the store. So PPI is the early warning system. It tells the Fed and the market whether the inflation pipeline is clearing or whether new pressure is already building before it shows up in consumer prices. Yesterday's CPI told us that prices at the checkout are not accelerating right now. Fine. But if today's PPI tells us prices at the factory are still rising, or worse, accelerating, then the clearing hasn't actually happened. It just hasn't shown up yet in the number everyone was watching. That is why, in a week where September's rate decision is a coin flip, PPI carries unusual weight. A hot PPI would undercut the modest relief that yesterday's CPI delivered. A cool PPI would reinforce it and build a more complete argument that the Fed has room to hold rates steady in September. For gold and silver specifically, hot PPI means the inflation pipeline is still pressurized. The Fed has more reason to act in September. Rate hike odds climb, the US dollar firms. Gold and silver, which pay no interest and are priced in dollars, face selling pressure. Cool PPI means the pipeline is clearing. The Fed has less urgency. September hike odds fall. The dollar eases. Gold and silver become more attractive because they're no longer competing against the prospect of meaningfully higher yields. The consensus expectation for today's number, a modest monthly rise of about 0.2%, with year-over-year producer prices coming in around or below May's elevated pace. That's the soft to inline scenario the market is partially pricing in after yesterday's CPI. But here is the important qualification. Because last week's jobs report already shocked the market, any upside surprise on PPI this morning carries outsized psychological weight. The market absorbed one shock this week, with 23,000 jobs lost when 80,000 gains were expected. A second shock in the opposite direction, hot inflation at the production level, would create a very specific, very uncomfortable picture. And that picture has a name I need to introduce properly. Section 3. The word nobody is saying clearly enough. Stagflation. Stagflation. That's the word that's been sitting in the background of every data release this week, and it's the concept that changes how you read today's PPI, regardless of which direction it breaks. Stagflation is what happens when two things occur simultaneously that normally work against each other. The economy slows, job growth weakens, consumers pull back, and at the same time, inflation stays elevated or continues rising. Normally, those two forces cancel each other out. When the economy slows, people spend less, demand drops, and prices ease. That's how recessions typically bring inflation down. But in a stagflation environment, that mechanism breaks. Prices stay elevated even as the economy weakens, and it puts the Federal Reserve in an almost impossible position. The Fed's normal tool for fighting inflation is to raise interest rates, but raising rates into a weakening economy accelerates the damage to growth and employment. It's like pressing the brake pedal when the engine is already stalling. There's no clean answer. Every direction the Fed moves creates a new problem. Now look at what the actual data is assembling right now, piece by piece. Last Thursday, August 7th, jobs report. 23,000 jobs lost when 80,000 gains were expected. The labor market cracked. Yesterday, August 12th, CPI came in at 3.4% year over year. Inflation is still running 70% above the Fed's 2% target for the fifth consecutive year. Oil. Brent crude has been trading near $83 to $86 per barrel, elevated because the Strait of Hormuz situation has kept energy costs under pressure. This matters specifically because the Federal Reserve cannot fix restricted shipping lanes by raising interest rates. Rate hikes do not open waterways. What rate hikes do is slow the economy while supply-driven oil inflation continues underneath. And at the most recent Fed meeting on July 28th and 29th, the vote to hold rates was 9-3. 3 regional Fed presidents voted for an immediate rate hike. That's the strongest hawkish dissent since September 2016. Weak jobs, sticky inflation, oil pressure the Fed can't cure with rates, a central bank internally divided about which direction to move. Those are the pieces of a stagflation setup. Not a confirmed one, not yet, but the pieces are assembling, and today's PPI is the third data point in that sequence. If producer prices come in hot this morning, after last week's weak jobs and yesterday's sticky CPI, then the market will have 3 consecutive signals pointing in the same uncomfortable direction at the same time. That's when the stagflation conversation moves from background whisper to the front of the conversation. Here is why that framework matters, beyond just one week's data. Historically, stagflation is one of the most powerful macro environments gold has ever performed in. During the 1970s, the last serious stagflation era, gold rose approximately 2,000% over the decade. Not because everything was fine, because nothing was fine, because the Fed couldn't easily fix what was broken. A short-term pullback on a hot PPI in a building stagflation environment has historically been the kind of dip that gets absorbed and reversed. The short-term reaction and the medium-term setup are two different stories. Understanding both is what separates a reaction from an interpretation. I want to be honest with you about something before we get to the scenarios. Silver's technical picture heading into today's data is actually more interesting than gold's right now. And the reason why tells you something important about what happens when monetary demand and industrial demand hit a market at the same time. Stay with me. Section 4. Silver's technical break and what it means. Yesterday, something happened on Silver's chart that technical analysts had been watching for. Silver broke above a downward trend line. That trend line had been defining Silver's price action for multiple weeks, a succession of lower highs that told you selling pressure was still in control. When a trend line like that breaks, it signals that the prevailing pattern is changing. The sellers who had been in charge are losing momentum. Silver's close above that trend line yesterday, on the back of the CPI relief bid and a broadly positive session for metals, is technically meaningful. The next resistance level analysts are now pointing to is around $71.50 per ounce. From yesterday's $66.20, that's a further move of approximately 7.9%. But, and this is the critical part, the trend line break only holds if silver stays above it. If today's data causes a sharp reversal and silver closes back below the broken trend line, the breakout becomes a false signal, and the old pattern likely reasserts itself. Silver also behaves differently from gold in one important way that matters for today specifically. It carries two separate demand engines: monetary sensitivity, the same reaction to rate expectations that gold has, and industrial demand. Silver is used in solar panels, electric vehicles, data center electrical infrastructure, and electronics manufacturing. A hot PPI doesn't just signal that the Fed might hike, it also signals cost pressure at the production level, which implies either margin compression for manufacturers or price increases passed down the supply chain. Both weigh on industrial demand forecasts. Silver absorbs today's data through both channels simultaneously. That's why it tends to move further than gold in both directions. On Tuesday, August 11th, when Hormuz escalation briefly revived rate hike fears, gold fell 0.7%, while silver fell 1.59%. The same dynamic works in reverse when data is friendly. Silver's larger percentage moves aren't noise. They're the market reflecting a two-engine asset hitting a single data event. Section 5. The three scenarios mapped out before 8:30 a.m. Let me map exactly what each outcome looks like, because understanding the branches in advance is more useful than scrambling to interpret the reaction after it happens. Scenario A. PPI comes in hot, above expectations. The immediate reaction. September rate hike probability jumps. Right now it sits around 48 to 52%. A hot PPI could push it towards 60 to 65% within minutes of the release. The dollar firms. Treasury yields, currently around 4.7%, tick higher. Gold faces selling pressure. The key support level to watch in this scenario is $4,370 per ounce. That's the level where buyers have consistently stepped in through recent volatile sessions. A dip toward $4,370 that holds, meaning gold pulls back to that level and then closes back above it, signals the bull structure is intact even against a hot print. A clean close below $4,370 would require a different assessment. Silver in scenario A would likely feel the pressure harder than gold, for the two-engine reason we just discussed, and the trend line break from yesterday becomes critical. If silver can't hold above it on a hot PPI, the technical picture resets. But here's the deeper read on scenario A. Hot PPI after weak jobs and sticky CPI doesn't just mean a bad day for precious metals. It means the stagflation data sequence is now 3 for 3, and historically, that environment has been gold's strongest macro setup. The short-term dip, if it comes, sits inside a longer-term story that is actually building in gold's favor. Scenario B, PPI comes in cool or in line, at or below expectations. The immediate reaction. September hike probability drops, potentially from 50% toward 35 to 40%. For the first time this week, the market can build a genuine case, backed by 3 consecutive data points, that the inflation pressure is not accelerating. Weak jobs, inline CPI, cool PPI. 3 pieces pointing the same direction. The dollar eases. Treasury yields pull back from 4.7%. Gold rallies. The next resistance zone above yesterday's close sits in the $4,450 to $4,500 area. A clean break above $4,500 is particularly significant. That's where systematic trend-following funds receive mechanical buy signals that can become partially self-reinforcing. Silver in scenario B would likely outperform gold on a percentage basis, consistent with yesterday's session where silver gained roughly twice gold's move. A cool PPI adds the fundamental fuel, lower rate expectations, weaker dollar, improved industrial demand outlook, to the technical breakout that already started yesterday. Scenario C, PPI comes in exactly in line with expectations. The relief trade fires, but more modestly. The market was bracing for possible upside surprise. When it doesn't arrive, the anxiety unwinds. A modest rally in gold, perhaps 0.5% to 1%, with silver outperforming at 1.5 to 2%. Directionally the same as scenario B, but with less momentum. September hike odds drift lower, but don't collapse. Section 6. Jobless claims, the second report landing at exactly the same time. Here's the dynamic most people aren't thinking about. Both reports, PPI and initial jobless claims, drop at exactly 8:30 a.m. The market absorbs them simultaneously, and they can either amplify each other or create a confusing conflict. Initial jobless claims is the weekly number of people who filed for unemployment benefits for the first time. In a normal week, it's background noise. This week, it isn't. Last week's jobs report was the shock that moved everything. But one monthly payroll reading is not a trend confirmation. The market knows that. Traders are hungry for any follow-up signal about whether last week's weakness was genuine or just a one-month anomaly. The consensus expectation for today's jobless claims is around 202,000, modestly above last week's 199,000. A number significantly above that would confirm that layoffs are real, ongoing, and spreading. That confirmation reinforces the case against a September hike and supports both gold and silver. A number significantly below consensus would raise the question of whether last week's jobs number was a statistical outlier. If employment is actually holding up better than feared, the Fed has less reason to hold back. Now, the simultaneous release creates 2 powerful combinations: cool PPI and high jobless claims together, 2 signals confirming the same story. The market reprices aggressively toward a September hold. The rally accelerates. Hot PPI and high jobless claims together. That's the stagflation signal arriving in real time, rising prices at the production level alongside a cracking labor market in the same 8:30 a.m. release. This is volatile territory. The short-term move might be choppy as the market tries to decide which reading dominates, but the medium-term implication is the one I described earlier. Whatever combination arrives this morning, the data is being watched in the context of everything that has already landed this week. The interpretation isn't happening in isolation. Section 7. What comes after? Friday and beyond. Today's data is important, but the week isn't finished after 8:30 a.m. Friday, August 14th, brings 2 more readings. Retail sales for July, a direct read on consumer spending, which drives roughly 70% of the U.S. economy. If consumers pulled back in July despite elevated prices, that's another piece of the stagflation puzzle. Prices rising, spending falling. Also on Friday, the University of Michigan Consumer Sentiment Report, specifically the measure of long-term inflation expectations. Fed Chair Kevin Warsh has cited this survey directly in his policy communications. If households expect elevated prices for the next 5 years, and if that expectation rises in Friday's reading, it creates institutional pressure on the Fed to act, even if the latest monthly numbers have cooled. And beyond this week, the single most important macro event for gold and silver in the next 30 days is Jackson Hole, the Federal Reserve's annual symposium in Wyoming, where the chair traditionally delivers a major policy speech. It's where rate pivots get telegraphed, where QE programs get announced, where the Fed frames its medium-term thinking for the rest of the year. Warsh speaks at Jackson Hole this August, his first time addressing the symposium as Fed chair. Every word will be parsed. His language on inflation, his framing of September, whether he signals any conditions under which the Fed would consider easing. Everything that happens in this week's data, PPI this morning, retail sales Friday, Michigan Sentiment Friday, becomes the context Warsh will be speaking to when he takes that stage. Today's number shapes that context directly. Let's bring it together. Gold closed yesterday at $4,424, a 10-week high. Silver closed at $66.20 after breaking above a multi-week downward trend line. Both rallies were driven by yesterday's CPI matching expectations, giving the market modest relief that inflation isn't reaccelerating. But the September rate hike probability didn't move. It's still sitting around 48 to 52%. Because CPI alone wasn't enough to close that question. Today's PPI and jobless claims, landing simultaneously at 8:30 a.m., are what the market is waiting on. Hot PPI means the inflation pipeline is still pressurized. September hike odds climb. Gold faces short-term pressure at the $4,370 support. Silver's trendline break gets tested, but hot PPI in the context of this week's data also builds the stagflation case, which has historically been one of gold's strongest environments. Cool PPI confirms the clearing. September hike odds fall toward 35 to 40%. Gold has room to push toward $4,450 and $4,500. Silver has room to extend toward $71.50. The 3 data point confirmation gives the market confidence to reprice. And Friday's retail sales and Michigan sentiment add 2 more layers before the week is finished, feeding directly into the context Warsh will be speaking from at Jackson Hole. The most important thing I can leave you with is this. Whatever the short-term reaction to today's data is, it is happening inside a longer-term structural picture that hasn't changed because of 1 week's numbers. Central banks are still buying gold at a 20-year pace high. Silver's supply deficit is heading into its 6th consecutive year, and the conditions, elevated debt, a divided Fed, geopolitical oil pressure the central bank cannot easily fix, are building a framework that historically favors gold over time. Today's data tells you where the market goes in the next session. The structural picture tells you the direction of the next leg. Watch both, understand both, and don't confuse a day's move for the whole story. Drop your call in the comments, hot, cool, or in line on PPI today, and I'll be back after the data drops to walk through exactly what it showed and what it means for what comes next. Subscribe so you don't miss it. See you right.